Well, we've got certainly a different guest to speak to now, because if you combine scorching inflation, bond yields, geopolitical risks, volatility is certainly the name of the game. We're only a few weeks into 2022. We're feeling a little bit exhausted already. But what can we learn from past crises, such as the GFC? Jonathan Webster from Jamison Capital is joining us right now. Jonathan, we have to make some lessons from, for example, the GFC. Otherwise, aren't we deemed to repeat them?
Yes, well, and they say, you know, history doesn't repeat, but it does rhyme. I think, you know, from my experience, you can take away a lot from the GFC, and for those of us that were around, we probably witnessed gated funds and margin calls and forced selling and all these types of things. You know, I think I recall one of my more memorable tasks was contacting investors. I was working at an investment bank at the time, and contacting investors in a product that had geared senior secured US corporate loans by 4 times, and explaining to them the possibility of potential write-downs. So, you know, I think you learn from your past, and for a lot of us, experience makes us more risk averse. And certainly at Jamison, my current firm that I founded, we tend to focus on private market investments in order to reduce some of that volatility.
Yeah, so you're better prepared this time. So where do you put your money? How do you play that defensively?
So primarily, you know, we tend to steer away from the public markets. There are some great managers out there that do a really good job of playing those markets. For us, we're an alternatives manager, and you know, in alternatives more generally, there's a bit of information asymmetry. So the information is less readily available. That can mean there's less competition, and I guess a potential for a better entry point into setting some of these investments.
And of course, I can go back to the Asian crisis. We've had lots of crises over the last couple of decades, Jonathan, but I think the GFC is a little different, because since then, interest rates have been more or less on the floor, with very little exception. So now your investors have to have a conversation about what to do when interest rates rise. What sort of conversations are you having?
Yeah, so I mean, that's a very interesting point. You know, our clients, and I think clients in general, are seeking, you know, income plus some form of inflation protection. And there's a few different ways to play that game. One that comes to mind is certainly the private debt markets, which have emerged in recent years as a great source of alpha, and certainly an alternative to, you know, the bank's term deposits. Those sorts of deals, you know, were typically the sort of playing ground, were typically invested by family offices, but they have a much broader appeal now.
Jonathan, given the risks out there that we've just talked about, how much cash do you have on the sidelines at the moment?
So we've actually just raised a special situations fund. That fund is a $100 million hard cap fund to invest in mezzanine debt and preferred equity positions in hard assets, really real estate. So we've raised half of that money. It's $50 million at the moment. That's at call. And we're really looking for, you know, opportunities, I guess, that have experienced some form of dislocation or disruption because of the COVID crisis. And we're looking to set a portfolio of investments for the next 3 years and ride out that sort of COVID recovery, the reopening trade, as some people refer to it.
So, Jonathan, how did you speak to your clients earlier this year when you're reading horror stories about, you know, Bitcoin's down 40%, interest rates are rising? How do you convince people that volatility could be the new normal and there are still opportunities to invest even when the market looks like it's working against you?
Yeah, sure. I mean, you're absolutely right, Annette. I mean, risk-aware investors do become defensive. There's no doubt about that. And, you know, add to that mix the challenge of traveling globally to see institutions. Well, I mean, that just didn't happen for the last few years. So a lot of it was, you know, done via Zoom or Teams as we're talking now. But I think you also have to, remember that, bond yields were at a very, very low point. Equity PE ratios are very high. I mean, they're still relatively high. And there was a lot of capital sitting on the sidelines. And fortunately, we're starting to see that return to a bit of normality. I think investors generally are really open to a conversation where you're talking about diversifying, into uncorrelated alternatives away from their traditional 60% growth or stocks and 40%, defensive bonds type portfolio. And indeed, there's great precedent for that. The US's, endowment funds, Harvard and Yale have been, diversifying into alternatives for over 2 decades and with very great results.